Hello everyone, welcome back to the Daily Gold YouTube channel. Thank you so much for tuning in. This video is being recorded on the eve of Thanksgiving. So Wednesday, late evening, November 27th, 2024. And with that, I would like to wish everyone out there a very happy Thanksgiving. We all have a lot to be thankful for, and I would just like to say I am thankful for, among many, many things, my paying subscribers who allow me to do the work that I love. So thank you to them. A big thank you if you are a paying subscriber and you are watching the channel. Really appreciate it. And to all of you viewers out there and YouTube subscribers, I also appreciate you and your interest. So thank you. Now, with that aside, let me get to this video. And I'm going to touch on a very important catalyst for gold. This is something I am discussing in my book, so I'm commenting on a little piece of one chapter in my book here, which is almost ready. I hope to have that out to paying subscribers in PDF form in the next week or two. But let me get to the game-changing catalyst for gold. And Jared Dillian talked about this in our last interview, and others have talked about it as well. And that is the United States government fiscal position, which is really approaching, or I shouldn't say it's approaching a code red. It is really getting to that code red territory. And I have a couple charts here to go over. And so you have a big deficit, but the real problem now is the interest on the debt is really starting to accelerate. And you'll see that more in this chart, actually. So this chart shows the budget deficit in black. These are in billions. So, you know, I think 1.8 trillion is what the deficit came out to fiscal year 24. And so we have net interest. So there's gross interest is what people look at, but there's also net interest because the United States government does make some income, some interest income on its various assets. So while the gross interest is clearly over $1 trillion now, the net interest is pretty high. And so this is approaching 900 billion. So I don't mean to skip ahead, but I did. But I just wanted to show you this chart so you can look at this. And then also this one, you know, I don't know, maybe I should have put them in reverse order. But anyway, so there's three components here. There's the debt to GDP, and then there is the interest on the debt. So blue, this is the gross interest, and black, this is the net interest. So the net interest is really more important in my view. But, I mean, they're obviously both important. And I just want to go back and do a little history lesson and talk about why now we are really in the position where we're going to have to print money to pay for the debt. We're going to have to monetize the debt. We're going to have to do yield curve control at some point in the next few years, I think. And that's going to be the major catalyst for gold. So here's the problem. You could go back to the Great Depression, and yes, gross and net interest was off the charts. I mean, and by the way, looking at the interest, this is a percentage of federal revenue. So I prefer this more so than GDP because this is looking at how much is your net interest based on how much money the federal government is actually bringing in. So I think this is better than looking at against GDP, but I mean, that's fine. That's just my personal opinion. So you go back to the Great Depression, and so the interest costs spiraled out of control, you know, at the beginning of the Depression. Then, of course, we had to do yield curve control. I think, you know, when did we start that? 42, I think. So middle of the war, you know, to 1951. But here's the thing. If we're looking at here in the Great Depression, when this started, look at debt to GDP. I mean, debt to GDP was only 40%. So it was only 40%. Now, debt to GDP, Ray Dalio says 130%. Like, that's when you're done. That's when you're, you know, you're officially screwed. I was going to say the F word, but I'm trying to have better manners. So 130%, that's when really the shit is going to hit the fan. So here, there was a lot of room for the debt to go up. So, of course, the debt goes up, you know, during the Depression, really surges during the war. But so the debt to GDP is going up here massively. You know, this peaked right around 120%. But as it was happening, you know, interest costs were going down because we did yield curve control. You know, the economy was doing shitty. So, you know, we kept interest rates really low. Of course, there was huge inflation in the 40s, but we're able to get out of that because interest on the debt plummeted. Okay. Now we look at the late 80s, early 90s. Remember Ross Perot? and his, bid for the presidency, most successful third-party candidate of all time, at least in modern times. So there was a huge difference then. I mean, look at gross interest. Wow. I mean, that is amazing. Almost like a third of percentage of federal revenue. But net interest then was not that high. So there's a big difference. But also at the same time, look where debt to GDP was. Okay, I mean, it bottomed here, before Reagan came in. So in the early 90s, I mean, this was, 60%. So there was a lot of room to increase debt at that point. We had to get interest rates down and get interest as a percentage. We had to get that down. And we did. And also, let me go back here and look at the late 60s and 1970s. Yes, the inflation killed us, but from a government bankruptcy standpoint, because of that, I mean, during the beginning of that period, we deflated the debt in terms of debt to GDP. So that was coming down. Yes, interest costs were going up, but, net interest really wasn't an issue. So here's the problem now. Debt to GDP, 123% now. Remember, Ray Dalio said 130%. I mean, that's when you're really there's no turning back at that point. So there's barely any room for the debt to GDP to climb. And look at where interest on the debt is. I mean, let's look at net interest here in black. I mean, gross interest is a quarter. 25% of the money the federal government is taking in. Net interest is almost at 20%. So net interest has exceeded this point. But remember, back here, debt to GDP was not that high. So now you have debt to GDP, again, they're almost at 130%. And interest on the debt is really accelerating now. So we're going to need inflation to get debt to GDP down. And just like at the end of the 40s, that happened. So we're going to need inflation. And we're also going to need to keep interest rates really low so that interest on the debt, so that we can outgrow that problem as well. And okay, let me get to the other chart. So here we can see, again, this is the budget deficit in black. And so I'm looking at, how much is the interest on the debt? This is nominal, by the way, in billions. So how much is the interest on the debt really affecting the budget deficit? And we can see it's a lot at this point. They're trending in the same direction. I mean, this was the COVID peak. Now we're coming up again. And we can see the net interest on the debt, nominally speaking, I mean, this was in a range until like 2017, until 90 to 2017 or so, and now it's really picking up. And again, this is net interest. So this is really this is a big problem. And so, I mean, how are you going to get the budget deficit down when interest on the debt is really just skyrocketing? It's not just accelerating. This is skyrocketing. So I know that's a lot of talking for a couple of charts, and I hope I gave a decent explanation. I know it was a little roundabout at times, but the reality of where we are is, at some point in the next few years, we're probably going to need to monetize the debt. We're probably need to do yield curve control. Scott Bessent, I think, is talking about selling 50-year, 100-year bonds. And so we are going to have to keep rates low and run the economy really hot to grow out of the problem. But that's going to be inflationary. You're going to get a commodity bull market. And at the worst parts of that, and at the beginning, when that policy comes about, I think we're going to see gold, really take off at that point, really accelerate. And so I'll just wrap it up with, I talked about this in a past video or two past videos. And so this is the first correction after gold broke out to a new all-time high. So there's 3 breakouts to a new all-time high. I'm not counting the '07 one because the context was totally different than these 3. I should have labeled these, but I think, okay, this one here, this is after the breakout, it was the 1978 breakout. So after the 45% or 47% bear, gold comes storming back, breaks above 200, goes up to 220, or 240 rather, comes back to 200, does that sharp retest, and then it's off. So this is after that point, 400% in 14 months into the 1980 peak. And so this is 1972 or late 72 into 73. So gold breaks out. It breaks above the 68 high in 72, has a good run. Then it pulls back to the 200-day. And after that point, I think we're in 1973, gold triples in 15 months. Now, this is the last one. This was 2009, 2010, where gold breaks out September, October 2009. Then it rises, moves to, I think, 1250 or so. Then it comes back, does a retest of 1,000 or bottoms at 1050 or so, not a perfect retest. Then after that point, it rises 51% in 15 months. So even if we just follow that, that would put gold at roughly, almost 4,000 in Q1 2026. So I guess the point is, if we see a correction here that continues into next year, gold tests and bottoms at the 200-day, it could be similar to these three past corrections after a move to a new all-time high. And so after that correction, this is the kind of move that you had. And so my point is, maybe this type of move is what aligns with the things I was talking about earlier in the video, having to monetize the debt, having to do yield curve control. So just some food for thought. That's it for the video. Appreciate you listening all the way until the end. Let me know what you think. Leave a comment. And again, hope you guys are having a great Thanksgiving. Thanks so much. And I'll see you guys on Friday for the weekly wrap.